What a day it has been for markets. Of course, the last 6 days as well, we have seen a consistent market meltdown. Investors have now lost over 15 lakh crore rupees in just 6 days. Markets have been consistently declining. And today, the Sensex plunged 900 points and ended at 63,148, while the Nifty has declined 264 points and ended at 18,857. So why then are the markets consistently declining, and why have we also seen a global market sell-off? Remember, it's not just Indian markets, it's also global markets. So to decode this further, I'm joined by Nasir Salim, Managing Partner at Flexi Capital, and Amrish Balega, veteran market expert. Thanks very much for joining us, both of you. And of course, I'd like to begin by asking you, Nasir Salim, are fears of the Israel-Hamas war widening, now dominating sentiment really among investors?
Good evening, Sakshi, and thank you for having me on your show. I think, predominantly the cause of concern which has been building up is obviously this entire geopolitical tension building up on the war front. And that is playing on sentiments. There is impact on input costs going up on account of crude. Before the war broke out, I must tell you, we were trading at about $85 a dollar on Brent, on crude, and today it's now hovering around $95. So obviously input starts to go up, input costs start to go up, and therefore they have actually a very, very huge negative impact on an economy that imports more than 75-80% of oil. So I think that's the first impact that we are seeing, and it's a domino impact across sectors and market caps, large caps, small caps, and obviously mid caps, taking a bit of a hit there. I think the second quick one, Sakshi, is obviously markets don't like uncertainty, right? There is FIs selling. The FIs have been pulling out consistently. Of course, there is a massive retail participation coming in the equity stock markets, as we see, thanks to this entire India story. Structurally, mid-term, long-term, we're very strong. But sentiments do get dampened when in the near term you see risk shooting up. I think that is something which is also on the play at the moment. From a price to earning perspective, because we track equities, we were in neutral zone. Today we've become far more attractive because we've fallen by a large, almost crashing over 3,000 points in 6 trading sessions. So I think, from a buying perspective, things have really changed and evolved in the Indian equity stock markets over the last 5 to 6 days. I think the other very quick one that I would want to say is that there was a lot of froth building up in the mid cap and the small cap stocks. Mm-hmm. That has also kind of to a large extent corrected. We've seen a marginal drop in those prices, and I think what is evident is that in terms of uncertainty, we see some of the volatile indices such as small and mid caps taking a larger hit. I think that is something which is played out again clearly, and of course inflation fears. Today, if India, we are a net importer of oil, as I said to you. If there is pressure on inflation on account of oil input costs going up, that's going to have a huge impact on our fiscal prudence that we've been able to maintain over the last few quarters. I think that again, Sakshi, is playing up on the market sentiments. All so right. I think broadly some of these are the reasons why we've seen a meltdown in the stock markets.
All right, Amrish Balega, do you agree that uncertainty is really driving this sell-off then among investors?
Absolutely, because till date, if you look back about the last 7-8 months, it was liquidity which was driving it. So retail money was chasing momentum. And we have seen the mid-cap and the small caps valuations were getting quite steep. I mean, we have seen so many multi-baggers in the last 7 months. You normally see multi-baggers over years, but the last 7 months, we have seen quite a few multi-baggers. So at some point, you need, much more liquidity and very strong positive news to actually just keep that momentum on. Mm-hmm. And this leads to a bubble. So basically, it needed a reason to fall. And that reason finally came as possibly the US Treasury yield spike. We can talk about the fear of the Israel-Hamas war widening. And because of that, the oil prices possibly going up, possible supply chain disruption, inflation, a lot of these things we can talk about. But end of the day, now we are seeing that fear on the street as far as the retail investor is concerned. And when there is fear, liquidity dries up. And when liquidity dries up, the market falls under its own weight. So, but at some point of time, it will become attractive for the smart money. And I believe that possibly levels of closer to about 18,000, 18,500 levels in that band, I think we could see a lot of smart money coming in again.
All right, Amrish Balaka, then your outlook for the near term and the sectors that you feel will be hit most.
No, because see, in the near term, I mean, I would still bet on sectors like pharma, automobile, FMCG, white goods, because of the festive season. Normally, the demand for all these go up. So I think that's one space to be, where one can bet on from a short to medium term angle.
All right, and Nasir Salim, over to you. As far as sector-specific advice is concerned, which sectors would you be cautious on and which would you be bullish on?
So let's talk about the good news first, Sakshi. I think the sectors which we're going to be bullish on, I agree with my fellow panelists. I think, automobiles and logistics is something which is, and, it's very simple. I mean, to your viewers, all that I want to say is just track earnings of those companies. Today, you walk into any of the automobile showrooms, you will not find a car off the shelf. There is a minimum waiting period of 3 months. Of course, there are supply chain issues in terms of microchips and all that, but still the demand is very strong. So automobiles clearly is one sector. Logistics, again, is something which is combined with it. I think the other very interesting cycle that we're witnessing, Sakshi, is way back in 2002 and 2003 when we saw CAPEX cycle picking up. I think today India is again at a very interesting point where we see a lot of infrastructure along with manufacturing starting to take shape and pick up in terms of good order books. So if you look at some of these underlying companies which are in the infrastructure space, which are also in the manufacturing space. Of course, there's a lot of work to be done still, but we feel some of these companies may augur very well if interest rates don't go up further, which is what again we're betting on.
Right.
As far as India is concerned, right, those two sectors are very good. The cautious clearly remain the IT space because again a lot of domestic businesses are getting hit. You saw estimates on TCS, Wipro. They were off their estimates for Q2 2023 estimate number, and the number that came out with them was off the record. I think anything which is to do with consumption or order book to do with global order books such as the US or the western parts of the world will impact some of those revenues. So IT, I think, is a sector which can get hit if the US Treasury continues to be where they are.
All right. Thanks very much for joining us and for sharing your insights. We'll be back with more news and updates after a very short break.